Good afternoon, everyone. Good afternoon, good morning, everyone. We are going to move ahead today and continue with the homework in Chapter 10, which is posted here on the slides and on Blackboard materials as well. Okay, and let me see, I see a lot of, okay. So just to remind you, we are having our first quiz on 10-1. It's posted also on the announcements, CUNY Blackboard. Our first quiz is on 10-1, okay, and is going to cover Chapter 10, all right? Oh, great. I see some here. People are making opportunities to work in study groups. That's a great idea, especially in this virtual environment. Any type of feedback you can get from your classmates or anything, I would definitely recommend that. So good for you. Okay, so quiz on 10-1, only Chapter 10. Okay, so again, when we're talking about Chapter 10, we're talking about bonds payable. I'm going to give you, and again, the quiz is going to be on McGraw-Hill. Okay, you're going to have the time period from 10:10, I think, till 10:40. Okay, you're going to have half an hour to complete the quiz, and then we are going to continue with the class after that, live. Okay, so that's just so a little heads up. Also, this Thursday, okay, it's going to be a taped class. Denise, yes, please. Do you please have your cameras open and your mics as well? Okay, when you're taking the quiz. That would yes. Thank you. On your laptop. All right. All right. So what's going on with our investment, guys? Not so good. Apple was selling at. I'm sorry, Denise. Yes, McGraw-Hill. Just have on your on your computer, just when you're on McGraw-Hill, just keep your microphones and cameras on. Okay. No, 10-1 is not the next class. The next class is going to be on this Thursday. Okay, and this Thursday we are just going to continue, and we're going to have a taped class. All right, but we're going to be continuing probably with Chapter 7 and even the next chapter after that. Okay. And then, so since the class is taped for this Thursday, you're probably going to be able to access it after tomorrow afternoon or evening. Okay, it's going to be uploaded then. So do it at your leisure. Just make sure you do review and go over the presentation. Okay, and just keep in mind that we're not going to meet. So this Thursday is a taped session. Okay, Tuesday we don't meet next Tuesday because it's one of those switch days where it's going to be a Monday schedule. So we don't meet the following Tuesday, but then that Thursday is October 1st, and the first half hour of the session is going to be a quiz. Okay, so we're moving ahead. Remember, review all the information about Chapter 10. We're going to continue going over the homework for Chapter 10 and starting the next chapter, which is Chapter 7. Chapter 7 is definitely a shorter, lighter chapter. I know these last two chapters have been a lot. So 7 is kind of a break. And then I'm anticipating having a midterm, okay, sometime. I think I gave October 13th will be our midterm. Okay, our midterm, I'm hoping, is going to be on Blackboard, and it'll just cover the first 3 chapters, which is Chapter 12, Chapter 10, and Chapter 7. Okay, now I'll announce that again in the announcement section. All right. Again, what's happening with our Apple investment? Not too good. The stock market is definitely taking a dip. There's a big sell-off in the tech sector. So this morning, a few moments ago, when I looked at the value or the market price of our Apple stock after the stock split, the price is $111.38. Okay, so again, after the split, we were hovering somewhere around $124 per share. So now the value of our investment again, and that's why you always invest for the long term, okay? Because you can have, especially in this volatile environment and with the election coming up. All right, so it's just something to consider. You wouldn't want to take your money out now because possibly you would be experiencing a loss. Okay, but it's nice to be able to track the stock and see what's actually some of the live information that's going on in the world now. All right. Okay, so let us continue now with I believe we're up to problem 10.8. Okay, now all right, so we have here on March 1st, Gardner Corporation received authorization to issue $50,000 of 9% bonds. Okay, so remember, this is the contractual amount. All right, $50,000 is the amount of the bond payable, and it pays 9% interest per annum. All right, and it has a 30-year life. Okay, now the bonds pay interest on March 1st and September 30th. All right, good. So the bonds are sold on March 31st. That's one of the interest payment dates. So we know then, okay, here, I'm sorry, but the bonds were not issued until April 30th. Okay, so whenever you're approaching a problem with bonds payable, all right, you're going to go through that checklist in your mind. What situation is this? Okay, so here, what is the situation? These bonds basically have accrued interest. So this is one of those accrued interest problems because of the fact that the bonds were not sold on an interest payment date. Okay, so here again, they're sold a month late. The interest payment date is March 31st. The bonds were not sold until April 30th. So what does that mean? That means that 1 month of interest has to be prepaid, okay, by the bondholders when they buy the bonds payable from the corporation. Okay, so now we're going to go through the journal entries. So this chapter is very big on journal entries. I posted, for those of you who said you didn't take Accounting 101 just last semester, remember some of the, I posted a group of the chapters from the Accounting 101 class, PowerPoints for those chapters. Okay, so if you have to rely on them, go back, review the journal entries. Okay, all right, so the first one, prepare the journal entry at April 30th to record the sale of the bonds. Okay, and again, they have accrued interest. So what is that going to entail? All right, so the bonds are sold for, the bonds are sold with accrued interest. How much is the actual accrued interest? Okay, we're going to take the face value of the bonds, which is $50,000. The face value of the bonds, which is $50,000. Then we're going to, let me just increase the font a little bit here. $50,000. And what are we going to do? We're going to multiply times the annual interest rate. Remember that it's times 0.09. 0.09, that's the annual interest rate. But then what else do we have to do? We're going to multiply. Remember, there's only 1 month of accrued interest. Okay, so we have to multiply now by 1 divided by 12. Okay, to get how much accrued interest for that particular month, and that equals $375. Okay, so what is the amount of cash that the bondholders have to pay to me, the corporation? The face value is $50,000. Remember, whenever you're doing a problem on bonds payable, always just credit the amount on the sale date. Just credit the bonds payable for the face value of the bonds. Get that out of the way first. Okay, that's the principal amount. That's the amount of the liability, regardless of the price the bonds were sold at. Okay, so you know the bonds payable are $50,000. You know that the bond interest payable Again, that should be a credit. Just kind of didn't print. It should be right under here, the bonds payable. We're also going to credit bonds interest payable on this day of $375. Okay, because that's the amount that you're going to also give to me, okay, for 1 month's interest, so that when the bonds are actually the first interest payment date on those bonds, I'm going to give that 1 month back to you, plus pay you for the additional 5 months of interest that you are due. Okay, so on the bond sale date, all right, here, what is the amount of cash you're going to give me? Because this is an accrued interest problem, you're going to give me $50,375. Okay, so that's the amount, the sales price of the bonds. Okay, now the next question is B. Prepare the journal entry at September 30th to record the semi-annual interest payment. So this is a regular semi-annual interest payment on September 1st. This is the first interest payment as well. All right. The first thing that, okay, so Dante, all right, when I'm giving examples, I am the corporation. Okay, you are the bondholders, I'm the corporation. So I'm selling the bonds to you. You're prepaying me 300. The bondholders are prepaying me $375. And then on the first interest payment date, I'm giving you back that $375. Okay, in addition, how many months of interest does this 1875 represent? How much interest is this 1875 on the interest payment day? Okay, how many months of interest is this that I'm paying, the corporation is paying? Not 3. Okay, what's the semi-annual? Very good, Dante, 5 months. Excellent. This 1875 is 5 months worth. Very good, Denise, of interest. Okay, again, how would I calculate that? Again, I would take the $50,000. Face value, always interest is accrued on $50,000 times the annual interest payment, which is 9%, and then I'm going to multiply. Then I'm going to multiply by 4/12. I'm sorry, 5/12. Okay, and that is going to give me the 1875. Okay, why does a corporation do this? So that whenever interest is paid by me, I'm the corporation, whenever the corporation pays the bondholders for interest, they're always going to be paying them for the full 6 months. Okay, and the reason here, even though I sold the bonds a month late, I'm still going to be paying you ultimately for the 6 months of interest. But it's also because you prepaid me for that 1 month when the corporation sold the bonds 1 month late. Okay, so that's the first. Now remember, when we're dealing with an accrued interest problem, the only journal entries that are really different are on the date of sale and then the first interest payment date. Okay, after that, it's the standard journal entries. Okay, the accrued interest has been taken care of. So here, it's just going to be the standard journal entries again, because really, these bonds were sold at 100. It's just that they had that accrued interest for that 1 month. So when we go to December the 3rd C, prepare the adjusting journal entry at December 31st to record bonds interest accrued. All right, so on December 31st, and remember, don't blow it with this, okay? How many months of interest are we going to accrue between September 30th and December 31st? It's going to be October, November, December. So it is 3 months. Okay, very good, Lysander. It's only 3 months of interest have accrued as of December 31st. So we're going to debit the bond interest expense for $1,125. Okay, again, go through the same calculation. It's a per annum interest rate, so you take the $50,000. You are going to multiply again by that annual interest rate, 0.09. Okay, then you have to multiply that figure by the number of months, which here is 3/12. Okay, and oops, that is going to give us a total of the $1,125. Okay, so here, when you have these exercises, I've given you now all of the equations, all right, so that you know how to basically record a prepayment of interest, the first interest payment, and then the accrual of interest at year end. Okay. And then Denise, I see here, does the quiz have to be on a laptop? Can you use a tablet? Yes, you can use a tablet. I'm not sure if the tablet has a phone and a camera. Okay, but whatever, I would prefer a laptop. Okay, but if you only have a tablet available, use what you have. Okay. All right. Then the last question here. Explain why the issuing corporation charged its bond investors for accrued interest in April. Okay, and again, these are theory questions. Theory questions are going to be on the exam as well. Okay, and that answer is here. Again, the practice of basically having the bondholders prepay the interest to the corporation, okay, basically means that every 6 months, the bondholders are going to be receiving a full 6 months of interest. The fact that the corporation sold the bonds late, okay, by 1 month, since the bondholders prepaid for that 1 month of interest, that basically means then the corporation always pays the standard 6 months of interest. Okay, but remember, if I ask you, and these are very common questions, okay, if I ask you what is the amount of bond interest expense, okay, if I ask you the amount of bond interest expense in 2018 or during the first year of this bond's life, what are you going to tell me? The bond interest expense is the $1,875 here, which is the amount that was accrued. I'm sorry, yes, the amount that was actually expensed on September 30th. And then you're also going to tell me, you're going to add the $1,875 plus the $1,125. Okay, last question. All right, before we leave the bonds payable when they are issued after an interest payment date, if I asked you on a question, if I asked you a question on the midterm, how many months of interest have accrued in 2018? What would your answer be? How many months of interest have been accrued as interest expense in 2018? 8. Excellent, Denise. Because remember, we accrued 5 months of interest between April 1st, okay, and September 30th, 5 months of interest, plus we accrued 3 months of interest from September through December 31st. Okay, so that's, remember that prepayment, okay, that the bondholders gave the corporation, that's not bond interest expense to the corporation. Okay, so tricky questions, but again, make sure you understand all the calculations, and we're going to be leaving accrued interest. Okay, keep in mind that, again, you always address what type of problem in the bonds payable we're addressing. And the homework problems and the homework exercises are good because we're going to go through each of those situations. Okay? So this is the first, accrued bond interest accrued between interest payment dates. All right? Very good. So let's go to the next problem. The next problem is, all right, so let's read it. Remember, you always have to identify what the issue is. All right, so here, Zonic Corporation issued $8 million worth of 20-year bonds with an 8% interest rate. That's a per annum rate. And they were, an interest is payable on March 31st and September 30th of each year. all of the bonds mature. And again, that's what we're always going to have. The bonds always mature. It's not installments. They always mature. There's a balloon payment by the corporation at the end of the bond's life when they mature. Okay, so and the fiscal year ends December 30th. For all our problems, that's pretty much what's going to be what happens. So prepare the journal. And now, what's the issue here? Okay, here, basically the bond's interest is payable March 31st, the bonds, all right, so what is the issue that we are going to address here with these bonds? The critical point is this, okay, the bonds are issued at 102, okay, so they were issued, the price that the corporation issued the bonds was at 102% of the face value. So what do? How do we figure out what the price of these bonds were under the situation? We take the $8 million. Okay, so now we're calculating how much cash does the corporation get on the date of sale. We always calculate it based on the face value of the bonds. We're going to multiply by the, and now to figure out the cash, we're going to multiply by the 102% or 102 because the bonds were sold at a premium. Okay, whenever bonds are sold at more than 100, we know that basically the bonds were sold at a premium. All right, so the amount of cash that was received by the corporation for these bonds equals $8,160,000. Okay, so right away, when you figure out that, you know that the $8,160,000 is the amount of cash that was received. So you debit cash. Again, you're always thinking of this from the corporation's perspective. Okay, now, what else? You know that whenever you're recording the issue date of bonds, you know that you're going to always credit the amount of the bonds payable. Sorry, this was a little cut off here. And you know that this amount that gets credited to bonds payable is always the face amount of the bonds, and that equals $8 million. Okay, so when in doubt, credit the bonds payable for the face value. And now you know the difference between the cash that was received by the corporation and the amount of the bonds payable is $160,000. Just make this little note. Just make that a little adjustment in your notes. For some reason, it was cut off. Okay, so premium on bonds payable, you know that that equals $160,000. Okay, now a little bit of a review. Okay, when bonds are sold at a premium, okay, when bonds are sold at a premium, okay, who remembers what does that do to the effective interest rate? When bonds are sold at a premium, does that raise or lower the effective interest rate paid by the corporation? Decreases. Excellent, guys. Denise, Shiung, Francisco, Jeffrey, very good. When bonds are sold at a premium, it basically lowers the effective interest rate. Okay, because of the fact that I'm making you pay me more upfront for those bonds, that additional $160,000. So that $160,000 is going to be amortized over the life of the bond, and that basically lowers the effective interest rate because that's going to offset some of the corporation's interest expense. Okay. All right, so here, that's the journal entry on the date of sale. The next journal entry is going to be on September 30th to pay interest and amortize the bond premium. Okay, so make sure, again, you're dealing here with a bond premium. It's the first interest payment date. So what do we have to do? We have to figure out, we're going to take the $106,000. That's the premium. And we're going to divide by the 20 years times 2, okay, or we're going to divide by the 40 periods that this premium is going to be amortized over. Okay, so every 6 months, because Joshua, we multiply the number of years times 2 because there are 2 interest payment dates per year. It's paid semi-annually. Very good. Very good, Dante. Okay, so the $4,000. So what is the amount of bond? Again, we're always going to work backwards. Okay, so when it's when bonds are sold at a premium or a discount, okay, yes, you're always going to multiply by 2 times the life of the bonds, which is here is 20 years. Okay, so what is your journal entry on the date of interest payment? All right, you know, if you multiply the $8 million, the face value of the bonds, times the stated interest rate, which is 8%, and then you multiply that by 1/2. Again, that 1/2 represents 6/12, right? Because now we're basically paying 6 months of interest. Okay, so here, how do we know that the amount of cash, okay, equals $320,000. That's how much the corporation basically must pay in cash to the bondholders. Okay, the stated interest rate times the face value. Okay, so this is $320,000. All right, get that out of the way first. All right, what else do we know? The amount of bond interest expense is lowered. All right, so this $4,000 that basically we calculated as the amortization of premium for this period, since, remember, always go back to the first journal entry. You see here how the premium, when we originally recorded it, it was a credit. That means when we're amortizing it, okay, the amortization of a premium must always be debited, because we're reducing it. We're reducing the existing balance. Okay, so we're going to debit the $4,000, the premium amortized for the 6-month period, and then the difference. Remember, this is always just going to be the difference between the cash and the amount of premium or discount that is being amortized here. So the $320,000 minus the $4,000 amortization of the premium equals $316,000. That's the amount of interest expense that's going to be recorded for each 6-month period for this bond. Okay, so every September 30th, this is going to be the journal entry to pay interest. Okay, again, you could see here what happens. The amount of cash that I'm giving, that the corporation is giving to the bondholders is $320,000, but realize the expense to the corporation is only $316,000. Okay, because again, you prepaid the premium to me, to the corporation. You prepaid, you gave a premium to the corporation on the date the bonds were sold. So that offsets or lowers the amount of interest expense the corporation has to realize. All right. Everybody good? Okay. Then let's go to C. On C here, this is, okay, so here they ask on March 31st, okay, what is the journal entry to pay? And this is 2038. So this is 20 years later. Okay, so 20 years later. And remember, this is the same journal entry that is going to basically be recorded each and every March 31st. Okay, so here, again, how much does the corporation have to pay the bondholders on each interest payment date? They must pay the bondholders $320,000 cash. Okay, that's how much I have to pay you. All right, because of the fact that it's I'm paying you for 6 months of interest. However, in this situation, okay, it's going to be a little different, okay, because of the fact that, first of all right, so when was the next journal entry that was recorded in the life of this bond? Okay, when was the next journal entry? In the first year, again, you have December 31st. But then what is the next interest payment date? The next interest payment date has to be at year end, which is December 31st, 2018. All right. So what happens on December 31st, 2018? All right. We know that interest must, the bond interest expense, yes, exactly. It's year end. So bond interest expense must be accrued. And that's going to happen at each and every year end. Okay. So what happens here? Oops. All right. I'm going to credit. Let's go, always work backwards. All right. For the bond interest payments, I know that I basically have to accrue bond interest expense. I'm sorry, bond interest payable for how many months on December 31st? It's going to be October, November, December. Okay, so the amount of bond interest expense for those months, it's going to be 3 months. Excellent. For those 3 months is going to equal, what is it, the $8 million? Okay, times the 8%. Times 3 over 12. 3 divided by 12. Okay, and that equals 8 million times 0.08. For the annual interest payment is $640,000. Then you're going to divide that or times that times 1/2 or divide it by 2. So the bond interest expense, is that correct? Oh, here. On December 31st, what is the amount of bond interest payable? Sorry, guys. They tricked me with this journal entry. Times 0.08. That's for the entire year. And we're going to divide it by 2. All right. So the bond interest payable, oh, no, it's only for 3 months. That's why. Divided by, so that's for 6 months. So you divide it by 6 equals times 3, so it would be 1/2. Sorry, 160,000. So the amount of bond interest expense for those 3 months equals 160,000. So that's the amount that has to be credited to bond interest payable. Okay, but what else do we have to do? Okay, we know that before we could figure out the bond interest expense, we have to figure out the amount of the bond discount. I'm sorry, the bond premium that is going to be amortized on this day. All right, so how many months of bond premium is going to be amortized? We know that it's going to be for only 2 months. I'm sorry, for only 3 months. So it's going to be half of the semi-annual amount. So the bond premium that is going to be amortized at December 31st equals $2,000. Okay, and then, all right, so let's just go through the calculation first. Now, what else is going to be debited? The bond interest expense. All right, so how much now is going to be debited to the bond interest expense on December 31st of each year? Okay, you know you're going to start, okay, you know the bond interest payable is $160,000, but you also know that you're going to amortize $2,000 of your bond premium. Okay, so how much is going to be debited to the bond interest expense? Remember, that's always a residual amount. Okay, anyone? How much is debited to the bond interest expense on December 31st? Come on, guys, bring it home. All right, it's going to equal, anyone? It's going to equal 158,000. Okay, here again, this bond interest payable. All right, that's the amounts of the liability at year end, okay, for the 3 months that have accrued. Okay, so that's the amount of the liability for the 3 months that have accrued. However, I know I also have to amortize my premium. My premium for the 4 months equals for 6 months. Okay, the premium amortized for 6 months equals $4,000. So that means the amount of the premium that is going to be amortized for 3 months is going to be half that amount. So we debit bond premium for $2,000. Okay, what's the difference now that is going, the residual amount that gets debited to bond interest expense? We credit bond interest payable. We debit the bond premium for $2,000. So what is the amount then that's going to be debited to bond interest expense each and every December 31st? It equals $158,000. Okay, now what is the next journal entry? Each and every March 31st, okay, this is going to be the journal entry. All right, so we see here bond interest payable, again, the $160,000. Remember, that's for the 3 months, okay, of, here we're reversing the 3 months of bond interest payable that we accrued as of December 31st. So that's the first thing we're going to debit. Okay, we also know what is the amount of cash that the corporation has to pay the bondholders every 6 months. Okay, we know that equals $320,000 because that's how much cash the corporation has to pay the bondholders. All right, which is the $8 million times 8%, the stated interest rate, times 1/2. Okay. So here, the $320,000 in cash is going to be credited. Okay. Now, we also know that 3 months has transpired between December 31st and March 1st and March 31st. So we know that an additional $2,000 of premium on bonds payable must be amortized, right? Because it's $4,000 for 6 months. Okay, so the premium for 3 months is going to be $2,000. Okay, remember, whenever you're amortizing a premium, since the premium has a credit balance on the date that it was created, okay, the premium then, when you're amortizing it, has to have the opposite balance. So here, the premium on bonds payable is debited for $2,000. All right, so how do we figure out the amount of the bond interest expense? We know the 300, remember that's always a residual amount. We know we have $320,000 credited for cash. Okay, we know we're amortizing $2,000 in premium for those 3 months. All right, and we know the bonds interest payable that we created on December 31st. Okay, we know we have to reverse it on March 31st, the bond interest payable. So this is now eliminated. So what is the amount that's going to be debited to bond interest expense? Remember, the debits and the credits must always equal. So the amount that gets debited to bond interest expense for that 3 month period equals $158,000. Okay. Now, is this clear to everybody? Bond interest expense is also, no, remember the premium that is amortized is always based on the period of time that's transpired. So for here, let's say on December 30th, how much premium has been amortized for April 1st through September 30th? We know that this is 6 months, okay, of premium that is amortized, okay, the $4,000. Okay, how much premium is amortized each December 31st? Remember, only 3 months have transpired, so 3 months of premium is going to be amortized on December 31st. Okay, and that's December 31st of each year. All right, the next, and that's only accruing the interest expense on that day. Okay, because it's year end and they're on a calendar year basis. Okay, and then here, the next bond interest payment day is always going to be on March 31st. Okay, so make sure you write down the calculations. Okay, because again, you always have to figure out what the time period that has transpired since the last journal entry. All right, so now let's bring it home. Everybody have this information? All right, I'm going to bring it home now. So then this is going to test your knowledge. All right, sure, Blackboard. Okay, so if I asked you potentially on an exam or a quiz, okay, what is the amount or what is the carrying value of these bonds, okay, of the Zonic bonds or Zonics at December 31st, 2018. Okay, so if I ask you what is the amount, okay, the carrying value of these bonds at December 31st, 2018, okay, what are you always going to do? You know that you have to start with the bonds payable. Okay, and remember, this is in the long-term liability section of the balance sheet. Okay, so this is now the balance sheet where we're going to record what the carrying value of the bonds are. So you know you're always going to start with the face value of the bonds. What's the face value of the bonds? $8 million. Okay, so now, but what's the other problem? We know that basically there is a remaining premium on these bonds payable. Okay, we know that we're going to have to add, because remember, the premium on the bonds payable increases, okay, the carrying value of these bonds. So how much of that bond premium have we amortized? Okay, we know that the full amount of the bond premium was how much? On the date of issue, the total amount of the bond premium was $160,000, right? If we go back to the problem, the original problem, we'll see that. Now, however, what happened? Okay, on the first interest payment date, which is September 30th, okay, we basically amortized a certain amount of that premium. Okay, how much of the premium did we amortize? Somebody have a question. I'm sorry, I'm getting here. You don't see this screen. The carrying value of the bonds, $4,000. Very good. All right. So here, just I'm not sure why. Just refresh, Lysander. Yes. All right. So very good, Francisco. The amount that we amortized on September 30th equals $4,000. So that decreases the amount of the premium, the remaining premium. Okay, but we also amortize the premium on another date. Okay, which date do we amortize more of the premium? On December 31st. Okay, again, how much? Very good, Francisco. Excellent. We amortized $2,000 of the premium on December 31st because that was for the 4 months. Okay, so what is the total that is remaining? Okay, on December 31st, what is the remaining premium on these bonds that has to be amortized? Okay, the remaining premium equals $154,000. Okay, $154,000, very good, because we take the $160,000 as of the date of issue, we subtract the $4,000 that was amortized on September 30th. We subtract from that the $2,000 that was amortized on December 31st. So here, when I ask you, if I ask you, what is the carrying value of the bonds as of December 31st? 2018, the answer, anybody? What's the carrying value of these bonds as of December 31st, 2018? Bring it home, anybody? Remember the remaining, excellent, $8,154,000. Very good, Christian. Okay, that is the remaining carrying value of the bonds as of, Let me just cross that out. The remaining carrying value of these bonds is going to be, that's supposed to be $8 million. $8,154,000. Okay. Everybody understand this? Everybody good? Okay, because we started out with a premium of $160,000. We know that it's amortized every significant date in the bond's life, which is the first interest payment on December 30th. Then we know every December 31st, we always have to accrue any interest expense. That's for 3 months. So the amount of the premium that's amortized is also for 3 months. Okay, so the remaining premium as of December 31st is $154,000. And remember, what does a premium do? Okay, what does the premium do to the carrying value of the bond? It increases the carrying value of the bond. But what happens to the carrying value of the bond over its life? The carrying value decreases. And that's because whatever the remaining premium is going to decrease in value as well. Okay? Everybody good now on bond premiums? Excellent, Denise, bringing it home. Very good. At the end of, oh, here, and I'll show you the slide. Very good. At the end, the carrying value is going to be 0. Okay, and that means then when I repay you, Denise, okay, when the corporation pays to the bondholders the amount of the debt on the date of retirement or on the date of maturity, how much are they going to pay? They're going to pay back the face value of the bonds. Okay, and that is going to be, and they ask here, what is the oops, next page. And I'll get your questions in 1 second. I just want to, all right, so here, what is the journal entry here? What is the journal entry on March 31st, 2038 to pay interest, amortize the bond premium, and retire the bonds? Okay, so here on March 31st, 2038, the bonds are now maturing. We're going to have this journal entry first. Remember, the journal entries remain the same over the life of the bond. But what else do we have to do on the date of maturity? We have to retire the bonds. Okay, so how do we retire the bonds? Remember, since the premium has been fully amortized now, the amount that the corporation is going to pay the bondholders is going to be the face value of the bonds, which equals the $8 million. Very good. Okay, now I see I have some questions. Dante, okay, so everybody through this point is good. The carrying value. Okay, and Joshua, don't get confused. The carrying value is not 0 at the lot when the bonds mature. What is the carrying value? Okay, upon maturity. Okay, upon maturity, 20 or 30 years later, when these bonds mature, the carrying value, exactly, Denise, always equals the face value of the bonds. Because all the premium now has been amortized, that means the corporation is going to back the carrying value of the bonds. Carrying value of the bonds equals the face value. Okay, Josh, it's just that the premium has been fully amortized, not the not the face value. All right, so always remember back into that question. Okay, and then D. Okay, very important. And please go over these exercises, especially before you do the quiz and the midterm. This is a great example of walking through these different experiences with the bonds. Okay, so here, letter D. Briefly explain the effect of amortizing the bond premium on the annual net income. Okay, now remember, when you amortize the bond premium, what does that do? It decreases the amount of annual interest expense. Okay, so because the annual interest expense would have been for the 9-month period, okay, which would equal I'm sorry. So for the 9-month period, the amount of bond interest expense would have been the $320,000. Okay, plus the amount at December 31st, which equals the $158,000. Okay, or the $160,000. I'm sorry. So if there was no premium, okay, the amount of bond interest expense would be $320,000 for the first 6 months, and then $160,000 for the last 3 months. Okay, but the fact that they amortized $1,000 of premium, okay, for that 9-month period, what effect did it have on the bond interest expense? It lowered the amount of annual interest expense. When you lower an expense, okay, it always increases the amount of net income. Okay, so again, when you have a premium basically lowers the amount of bond interest, and therefore it increases net income because your expenses are lower. Okay, that's a very good point. And then part 2 of that, what does, and this is a great question because we're going to get to this chapter, which is a little bit of a tricky chapter on the statement of cash flows. What does the amortization of the bond premium, okay, due to the cash, okay, from the annual cash flow from operating activities? Remember, amortization of a bond premium is a non-cash component. Okay, it doesn't affect the cash account. You're just amortizing the premium. So therefore, when you amortize a bond premium, it has no effect on the net cash flow. Okay, so amortization of bond discounts or amortization of bond premiums have no effect on the annual cash flow. Okay, everybody good? All right. So everybody, please make sure you review these exercises. Okay, so what haven't we dealt with yet? Okay, which issue haven't we dealt with? We know when bonds are sold at face value. That's the easiest. Okay, situation. We've gone over if bonds are paid, or I'm sorry, if bonds are issued between interest payment dates, the accrued interest. And we've gone over the journal entries when bonds are sold at a premium. Okay, so the last situation that we're going to deal with is when bonds are sold at a discount. And that's what we have here with Melillo Corporation. Okay, bonds here are sold at a discount. And you always want to address whatever the issue is before you start journalizing for the transaction. So you're going to read it here. Melillo Corporation issued $5 million of 20-year 9.5% bonds. So that's always the amount of interest that has to be paid annually. $5 million times the 9.5% per annum. Okay. The nice thing about this question is that the interest is payable on July 1st and on December 31st of each year. Okay. Why is that so nice? Because of the fact that you don't have to accrue interest now at year end. One of the interest payment dates is at year end. Okay, so let's just go through this. All right, so here, dealing with a bond sold at a discount by the corporation. Okay, so the first journal entry, letter A, is on the date of issuance, which is on July 1st. Okay, so these bonds are sold at July 1st. How do I figure out what the cash flow is going to be from this bond sale? Okay, again, the bonds here are sold at 98. Okay, so we know it's a discount problem. Okay, so when bonds are sold at a discount, what do? You take the face value of the bonds, which here are $5 million. Okay, and you're going to multiply by the percentage, okay, of face value that these bonds are sold at. And here you're told it's at 98. Okay, so the $5 million times the 0.98 equals $4,900,000. And what does that represent? That represents the amount of cash that was received by the corporation on this day. Okay? Now, we know that regardless of the amount that the bonds are sold for on the date of issue, you're always just going to credit the amount of bonds payable, the face value of the bonds. Okay? Because regardless of the sales price, the corporation needs to pay back the face value of those bonds on the date of maturity. Okay, so here, and again, just like with the bond premium, the amount of, okay, so here, what is the difference between the bonds payable, the face value, and the cash that was received on the date of issue? That difference here is going to be debited, okay, to the discount on bonds payable, which equals $100,000. Okay, so the discount on the day of issue is always debited, and it's going to be debited for the difference between the face value and the amount of cash received. Okay, what is the next significant date in the life of this bond? The next significant date is 6 months later, okay, which is on December 31st. Okay, so what happens on December 31st? All right, first we have to figure out how much cash, okay, does the corporation have to pay to the bondholders? All right, so very important, Joshua, okay, stick with me, all right? So when you're doing the interest calculation, okay, when you're doing the interest calculation, that's when you're going to look at the stated interest rate on the bond, which equals 9.5%. Okay, that's the interest that's paid semi-annually. Okay, however, on the date of issue, since these bonds were sold at 98, okay, again, that 98 represents 0.98% of the face value of the bonds. So the bonds were sold at less than the face value. So the amount of cash that was received was $4,900,000. The difference between the cash received and the bonds payable equals $110,000. So the 98 represents the basically the fraction of the face value that the bonds were sold at, and the 9.5% is the annual interest rate that is paid on those bonds. Okay, so on December 31st, we know that basically the corporation has to pay for 6 months of interest. Okay, so the $5 million times the 9 point, here it's 0.095, right? The amount of interest, the 9.5%. Remember, you have to always fractionalize it. 0.095 times the 1/2, because it's only 6 months of interest. So the amount of cash that must be paid to the bondholders is $237,500. Okay, now we have to figure out what is the interest expense. Okay, how do we figure out the amount of the bond interest expense? We have to amortize a portion of the discount. Okay, so now the full amount of the discount equals what? We know here, based on the first journal entry, the full amount of the discount is $100,000. Okay, on the date of issue, the discount is $100,000. Now, the life of this bond is how much? The life of this bond is 30 years. Yes, it's a 30-year bond. So here, I'm sorry, is it? No, they were issued in 2018. and they mature in 2038, so they have a 20-year life. So the $100,000 discount, okay, divided by the 20-year life times 2, because there's 2 interest payments each and every year. Okay, so the amount of discount amortized every 6 months equals $2,500. Okay, so remember, when we amortize the discount, we always do the opposite of what we did to the discount account on the date of issue. So here, the discount on bonds payable equals $100,000. It's a debit. So when we're amortizing a discount, it is always credited. Okay, so we're crediting the $237,500 in interest expense, okay, for that 6-month period. We're also crediting the discount, okay, for a full 6 months. All right, so 6 months, July 1st through December 31st. All right, so the discount is credited for $2,500. So what is the amount of the bond interest expense on each and every December 31st? It's going to equal $240,000. Okay, so, all right, what does the discount, okay, when bonds are sold at a discount, okay, what does it do to the effective interest rate on those bonds? Okay, when bonds are sold, very good. It raises or increases it. Excellent, guys. Excellent, Christian, Denise, Jason. Okay, so when the bonds are sold at a discount, the effective interest rate is higher. Okay, because the corporation accepted less from the bondholders up front. So therefore, as the discount is amortized, that's going to raise the effective interest rate of those bonds. Very good. Okay. The nice thing about this bond issue, is that the bond, So what the nice thing about this particular, bond issue is that the amount, the 2 journal entries are on July 1st and December 31st. So we don't have to accrue interest as of December, at any point between. I'm sorry, we don't have to amortize the bond interest expense on December 31st. It's for a full 6 months. Okay. Everybody good? All right. So let's see. Anything else? Oh, again, so when the bonds are paid back, okay, so this in 2038. Okay, now this is 20 years later, and these bonds are now going to be paid back by the corporation. Okay, so this is 20 years later. The bonds have now matured. Okay, so on the date when the bonds are now going to be retired, 20 years after the initial bond issue date, what's the first journal entry that has to take place? Remember, interest has to be accrued as of June 30th. Okay, again, the corporation is going to pay for 6 months of interest expense. Okay, we know that $2,500 of premium has to be amortized because it's been 6 months since the last interest payment on December 31st. Okay, so what is the amount of bond interest expense that must be accrued on the date of maturity? Again, you have to recognize the 6 months of interest the corporation owes to the shareholders. And then what is always the last journal entry? Here now on June 30th, after the last interest payment is made, now they have to retire the bonds. Remember, bonds are always retired at their face value. The corporation is going to pay back $5 million on the maturity date of these bonds because the amount of the discount has been fully amortized. Okay, so on the date of maturity of these bonds, what is the carrying value going to be? It's going to be the face value of the bonds at maturity, always. whether it's issued at a premium or a discount. All right, everybody good? And then here, just here, what happens on letter D? Briefly explain the effect of amortizing the bond discount upon the annual net income. All right, so now remember, whenever bonds are issued at a discount, it increases the amount of annual interest expense. Okay, because if these bonds were paid, all right, let's go back to the journal entry. If these bonds were sold at their face value, okay, what would be the amount on every June 31st? Okay, or June 30th, what would be the amount of the bond interest expense? It would just be the $237,500. It would be just for that 6 months times the 0.95% interest. Okay, but since these bonds were sold at a discount, this discount has to be amortized as well. The discount, when a discount is amortized, it raises the effective interest rate. Okay, so what is the actual amount of interest expense? Okay, every semi-annual period in this example, it's going to be $240,000, not the $237,500. Okay, because I had to also amortize that bond discount. Okay, I accepted less cash, or the corporation accepted less cash from the bondholders on the date of sale of those bonds. Okay, so that that discount is basically increasing the bond amount of bond interest expense annually. All right. Whenever whenever a bond is sold at a discount, it's going to increase the annual interest rate. And then remember, whenever expenses are increased, what does that do to net income? When expenses are higher, the amount of the net income is going to be lower. Excellent, Joshua. Okay, it reduces the amount of the net income. Okay, so always think through the answer. Think through your logic of what you know for the income statement. Okay, now, and again, number 2 of letter D, what does the amortization of the bond discount do to cash flows? Remember, whenever you're just amortizing a discount or a premium, that does not affect cash flows, because the amount of cash that the corporation paid to the shareholders didn't change. It was still $237,500. Okay, but it just increased the amount of the bond interest expense. Okay, so these 3 examples that we went over really conceptualize the whole what happens when bonds are sold between interest payment dates, what happens when bonds are sold at a premium, and what happens when a bond is sold at a discount. Okay, so this really gives you a good overview, okay, of what happens at the different prices that bonds can be paid, can be sold, okay, and what happens on the bonds interest payment dates. All right, so if there are no questions, we're going to proceed to the next chapter, which is a lighter chapter, which is chapter 7, and we're going to look at something called the sale of marketable or available for sale securities. So everybody ready to leave this? Again, this is what the next quiz is going to be based on. Remember that the next chapter is a partial chapter. Okay, chapter 7 is only looking at available for sale or marketable securities. All right, and here, I'll take you to the slide. So again, you don't have to read the whole chapter. Okay, we're going to be revisiting some of the concepts in this chapter later on. The things that you have to be, or that you're responsible for, start with slide 32. Okay, so it starts with, for chapter 7, what you have to cover is basically starting with with slide number 32. Okay, now, this is a really important chapter, all right, because it's dealing with short-term investments. Okay, and again, we're looking at short-term investments that publicly traded corporations purchase. Okay, so these are short-term investments for publicly traded corporations. Okay, and how they are reported. Okay, this chapter that we're going over is basically going to negate, okay, one of those core principles that we've talked about over accounting. And here, when we talk about short-term investments, basically, if they're highly liquid, okay, if they are highly liquid, they are extremely close to cash. Okay? All right. So let's go over the concept a little bit. A corporation, okay, a publicly traded corporation has excess cash. Okay? So a publicly traded corporation, and again, for those of you who are finance majors, this is really what's in the finance departments in a corporation. Okay, this is what the finance staff could be involved in analyzing. Okay, so these publicly traded corporations have excess cash. Okay, they don't want to leave this excess cash sitting in basically a checking account that is not generating any interest. Okay. So what does a publicly traded corporation do? A publicly traded corporation has the option that they can invest in either stock. Okay, a publicly traded corporation is going to invest in stock or equity of another publicly traded corporation. Okay, basically this corporation has excess cash, and we're going to talk about how much excess cash we're talking about in a little while. It's very substantial. So these corporations have excess cash. What do they want to do? They want to invest this cash to get a greater return. Okay, so they're going to invest in the equity or the stock or the debt, okay, of another corporation. Okay, so when we talk about short-term investments, okay, we're talking about those instances, let's say, where Apple Corporation is buying shares of stock, let's say in Amazon. Okay, so Apple, just for a short-term investment, is buying shares of stock in Amazon Corporation. All right, it is not it is not the situation. Okay, not the situation when Apple is buying shares of Apple stock. Apple is buying shares of Apple stock. Okay, this is a situation not Apple buying shares of its own stock. Okay, here the corporation is buying shares of another publicly traded corporation's stock or bonds payable. Okay, so it could be equity or debt that they're buying in another corporation. Okay, so these short-term investments typically are marketable securities, okay, that can be either bonds or stocks of other publicly traded corporations. Okay, and they buy it as investment. Okay, what we're talking about here, though, is that these marketable securities are readily marketable. Okay, in other words, these the securities that they're purchasing are highly liquid. All right, so if Apple wants to basically sell off some of the investments that they have in Amazon, okay, they could just call their broker and immediately liquidate the amounts of their investment. These investments are highly liquid. Okay, so these marketable securities are part of the current assets. If they're highly liquid, the corporation that's buying these securities, they're a part of the current assets. Okay, if the intent, okay, and it always comes down to the intent, if the corporation purchases these securities with the intent that they're going to sell these securities within the next year, okay, management basically says, we know that we are going to sell these securities in the next year. So management's intent is to sell the securities within 1 year. Okay, since that is the intent, they may list them as a current asset. Okay, and if management though plans to hold on to these investments that they've made in any other publicly traded company, then they would be a long-term investments. They wouldn't be considered a current asset. So it's always these investments are going to be recorded, taking into consideration what management intent was when they purchased these securities. If the intent of management is that it's just really short-term investments, we have some additional cash, okay, and we can sell these securities at any point. We have no vested interest in the companies we're buying in, then these securities are basically considered available for sale securities, and they're going to be listed directly below the cash account. Okay, so let's look at the dollar volume that we're talking about. Oh, here I have a question. Let's look at the dollar volume that we're talking about. So Joshua, is there a cutoff time? Yes. Okay, so Denise, basically what happens is that these, the management of these companies, okay, is basically when they're buying these securities, the intent is it's just for investment purposes, and the intent is they're going to sell these securities within a 1 year period. Okay, so what are we talking about? Again, let me just give a little bit. It's common for enterprises to invest a portion of their excess cash. So it's always excess cash, okay, that the purchasing corporation has, and they're going to invest, you're welcome, they're going to invest in the marketable securities of another company, okay? And when we're talking about the marketable securities, this could be stock or bonds payable of another corporation. So it could be debt or equity, okay, in another corporation. And again, why do corporations invest their excess cash in another corporation? Okay, why do they invest in the securities of another corporation? What do they hope to get, okay, by investing in the asset, in the debt or equity? They're hoping to get a return. Exactly. They're hoping that there's going to be an increase in the market value, just like the individual investors. Exactly. They're hoping that there is going to be an increase in the market value of the securities. Okay. And what else are they hoping for? And if it's stock that they invest in, what are they anticipating the return to be? An increase in the market value, and if it's stock, excellent, Christian, dividends. Very good. They're hoping that the corporation that they purchased the investment in is going to pay dividends, okay? Or if they're investing in the bonds payable, what do they know that they're going to receive every 6 months? Interest. Excellent, Christian. Okay, so just like the individual investors, these corporations are investing in other corporations, okay? And let's talk about the dollar volume that we're talking about. Look at the amount of investment that 3M had, a huge publicly traded corporation. They invested $626 million, okay? They had excess cash for this amount. For whatever reason, okay, management decides that they want to have this amount of cash liquid. Okay, so they invested $626 million in marketable securities. Okay, how about Coca-Cola? Okay, how much does Coca-Cola basically have invested in available for sale securities? $3.7 billion. Okay, huge amount. And just management decides this is the amount of cash they want to have readily available to fund their operations. Okay, they don't want to keep these balances in checking accounts. So what do? They invest in other corporations. Okay, and they invest because they want to see an increase in the market value of the securities, and they also anticipate dividends and interest, okay, based on their investments. Ford, what's the amount? Yes, these are actual amounts, Joshua. I think they're a little bit outdated. Okay, this book is, has been revised. I believe this is for, I would say, maybe for 2015. Okay, the date this book was, and these are the amounts, okay, of cash. But I would say whatever the amount of cash that they have now invested in marketable securities would be comparable. Okay, they're a little outdated, but yes, they're accurate. Okay, Pfizer, again, 3.2 billion. So you could see here, all right, I know, I agree. These numbers, and these are huge companies, and they, for some reason, and their management decides they want to keep this amount of cash liquid. Okay, so when we're talking about marketable securities, we're talking about highly liquid marketable securities, which are investments in other publicly traded corporations. Okay, and I know, okay, basically the finance department of these corporations knows when they want to liquidate some of their investments, they can just call their brokers and liquidate the investments. Okay, so you could see the amount of the dollar value that we're talking about here is is significant. Okay, again, they're investing in highly liquid marketable securities of other corporations. So they're investing in the securities of other publicly traded corporations. And again, management's intent, okay, when they buy these investments, okay, the intent of management is to sell these securities within a year. Okay, to qualify as highly liquid marketable securities, basically the intent of management at the time of the purchase is that they're going to sell them within the next year. Okay, so question, if, okay, Coca-Cola invests in another corporation, let's say they invest in, I'm just going to say Foot Locker, okay, if Coca-Cola invests in the stock or purchases the stock in Foot Locker, okay, but the intent is that they want to eventually have basically own, okay, be a major owner in Foot Locker, okay, and that therefore they want to have a controlling interest in Foot Locker. Would that purchase be considered a marketable security if they want to basically have a controlling interest in the company that they're purchasing for? Excellent, Christian Denise. Absolutely no. Okay, it would still be an asset, okay, but it would not be considered a marketable security. Why? Because if you want to have a controlling interest in a company, your intent is not to sell the shares of stock that you've purchased within a year. Okay, your intent is that you're going to hold it long term. So the amount of your long-term investment would just be shown as an asset further down on the balance sheet. Okay, so here when we're talking in this chapter, it's highly liquid marketable securities that these companies are buying in other publicly traded corporations. Okay, and GAAP requires that they're buying stock or bonds in other publicly traded U.S. corporations. Okay, it can't be privately held. All right, so let's walk through an example. Okay, so here, Foster Company is a publicly traded corporation. Okay, and they purchase as a short-term investment. Okay, so their intent here is to sell it within a year. Basically, they purchase shares, 4,000 shares of Coca-Cola stock. Okay, and they paid on this date, their broker told them that the market price of those shares was $48.98. Okay, on the date of purchase. All right, but they also have to pay a brokerage commission. Okay, and they're paying a brokerage commission of, I hate these slides that they're cutting off. They're paying a brokerage commission of, I'm sorry, what is, I wish the full, here, let me see if I can minimize this or maximize it. No, it doesn't show with maximizing. All right, so what is the amount of cash, I'm sorry, what is the market price of their investment on this day? We take the 4,000 shares and we multiply by 48.98. Okay, so the market value of these shares on this day equals $195,920. Okay, and again, that's if I take the 4,000 shares times the market rate, which is $48.98. Okay, but what else happens on this day? The corporation also has to pay an $80 brokerage commission. All right, so they also have to pay a brokerage commission on this day. So what is the total cost of buying shares on this day to the corporation? The corporation has to pay $196,000 on the date of purchase. Okay, does everybody see that? I'm sorry that it's divided here. All right, so since the corporation, and this is a pivotal point, okay, since the corporation had to pay $196,000 for these securities on this date, okay, what is the cost basis for these shares? Okay, the cost basis for these shares is not $48.98, okay, because they had to also, the corporation also had to pay the $80 commission. The cost basis for these shares on this day is $49 per share. Okay, does everybody see that? Okay, while the market value of the shares was $48.98, okay, the 4,000 shares times the $48.98 equals $195,920. But since they had to pay the $80 brokerage commission, the total amount of cash that they paid for in this investment was $196,000. So you always have to add the brokerage commission to the cost of your purchase. Okay, and that changed the cost basis for these shares to $49 per share. Okay, is everybody good up until that point? So you just have to factor in the brokerage commission. Okay. Why did the amount the company paid had nothing to do with the cost? It did. Okay, how did we come up? It always is the cost basis for your purchase. So what was the cost basis for this purchase? Okay, here, see how we came up with $195,920? Where did that cost basis come from? All right, if I took, we bought this corporation, I'm sorry. So Foster Corporation bought 4,000 shares of Coca-Cola stock. Okay, and how much was each, what was the market value of each share? $48.98. $400 and, I'm sorry, $48.98. Okay, what was the cost of, just based on the cost of the shares, what was the cost of those shares? $195,920. Okay, so that's the cost basis of based on the market price. But the corporation also okay, because they used a brokerage firm. The brokerage firm charged them an $80 brokerage commission. Oops. Yeah. All right. So the corporation also charged, in addition to the market value of the shares, the brokerage also charged them a commission. Okay, excellent question, Christian. Why wouldn't the brokerage commission be a separate journal entry? Because this GAAP basically requires that the fact that you wouldn't have been able, okay, Foster Corporation could not have purchased these shares unless they paid that $80 brokerage commission. They have to include that brokerage commission. I'm sorry, that $80 brokerage commission. They'd have to include that in the as part of the cost of the shares. Very good question. Okay, so yes, the brokerage commission, Jason, would always have to be given. Okay, so basically basically a good Christian. Basically, what you have to remember is include the brokerage commission when a corporation is buying or selling the shares or the bonds payable. The brokerage commission is always factored into the cost. Okay. All right, so what did these shares cost Foster Corporation? $196,000. Okay, and that's based on the market value of the shares of $48.98 per share, plus the $80 brokerage commission, and that would always be given. Okay, always, Denise, you would always be told the commission. Yes, it would never even be a rate. They would just tell you the dollar value. Okay. So again, just add that to the cost of the shares that were purchased on that day. So now the marketable securities account is debited for $196,000. Cash is credited for $96,000. But just as in your own, as in the same thing when you do your own investing, here remember that the cost basis for those shares is $49 per share, not $48.98. Okay, the brokerage commission raises the cost basis for those shares. Okay, you're welcome, Denise. All right, so everybody ready? Foster Corporation now has a marketable securities account. Where does this marketable securities account basically appear on the balance sheet? Okay, since they are considered highly liquid, marketable securities, they're always going to be reported directly under cash, okay, on the balance sheet. They're so highly liquid. I know these are shares in Coca-Cola. Coca-Cola is a publicly traded stock. Foster can call their broker at any point and decide that they want to sell some of those shares. Again, it's not guaranteed that they're going to sell at they're going to have a gain when they sell the shares. It's always going to be based on the market value of the Coca-Cola shares on the date that they decide to sell them. And remember, if you're a large corporation, remember that this marketable securities account is basically going to be made up of many different investments that you made in publicly traded corporations. Okay, remember on the earlier slide, we were talking about the amount that Coca-Cola, 3M invests in marketable securities. Again, here we're just dealing with a small corporation, Foster Corporation. But when you're dealing with huge conglomerates, you know this marketable securities account is going to be made up of purchases of many various marketable securities. So it's important that the corporation that's buying these securities always knows the exact amount and which companies they have invested in, which typically they would get from their broker. Okay, so this marketable securities account is usually made up of various purchases of stocks and bonds. Okay, and it's going to be based on various companies or corporations that this company has invested in. Okay, but we're just tracking as if it's a small company, they're just investing in Coca-Cola. And again, what is the intent of management on the date of this purchase? They have no vested interest in Coca-Cola. They just think that it's a good investment. The price of those, the market value of those shares, they're hoping is going to increase, okay, and the market value of those bonds is going to increase, so therefore they're investing in it rather than leaving the cash idle. Okay, so now the corporation has invested in 4,000 shares of Coca-Cola. All right, they have no vested interest in Coca-Cola. What happens here on this? Okay, so first on December 15th, and again, this is what the corporation is hoping. Foster Corporation is hoping that Coca-Cola declares a dividend. Okay, so here on December 15th, Foster still owns 4,000 shares of stock. So on December 15th, when Coca-Cola declares a 30 cents per share dividend on the 4,000 shares, okay, how much cash, okay, how much revenue is Foster recording? They're recording $1,200 worth of dividend revenue on this day. Okay, they received, Foster Corporation received $1,200, okay, but from its investment in Coca-Cola. So they're debiting the cash account, crediting the dividend revenue account. Okay, just a general journal entry here. Okay, they're recognizing dividend revenue because Coca-Cola declared a dividend, just like you would in your own personal investments. Okay, now, okay, what happens now? Again, this is a very marketable security. Foster can sell it at any time on December 18th. Okay, Foster Corporation decides that they need more cash. Okay, they want to liquidate a portion of their investments. All right, so what happens here on December 15th? Foster sells 500 shares of their investment, okay, in Coca-Cola. The market value of those shares on that day is $50.04. Okay, so we know the amount of cash that Foster is going to receive from this purchase is going to equal $50.04 per share, and they're selling 500 shares. Okay, but they're also charged a $20 brokerage commission. So remember, just like you added that brokerage commission to the price of your marketable securities purchase, when you sell shares of your stock and a brokerage company charges you a commission, the amount of the commission is going to be subtracted from the proceeds. Okay, so this amount, this $20 amount, the commission is going to be subtracted from the amount of the proceeds. So how much did the corporation actually receive? Okay, they only received $25,000 from their investment in Coca-Cola. Okay, because the market value was $50.04. They sold 500 shares, but they had to pay a total, and again, that's a total brokerage commission for this transaction was $20. Okay, it's a flat fee. All right, so very good. So the amount of cash that they received based on their investments is $25,000. All right, so always record that first. But what was the cost basis? Okay, what was the cost basis of their investment? Remember the price of those shares that they purchased earlier? Okay, the cost basis in those shares was $49 per share. So the $49 per share times the number of shares they're selling, the 500 shares, the cost basis in those shares is only $24,500. All right, so that's the amount that's going to be credited to the marketable securities account. They're reducing the marketable securities account by $24,500 because that's the cost basis. All right, so here the difference between the amount of cash that's received and the gain on the sale, and the marketable security cost basis, the difference between those two amounts is going to be the $500, which is considered the gain on the sale of the investment. Okay. And again, where is the gain on the sale of the investment? Where is that going to appear on the financial statements of Foster Corporation? Where is that gain on the sale of the investment going to appear? That account? Anyone? On the sale of the marketable securities, where are any gains shown? No, it has a credit balance, but where is it going to appear on the financial statements? Excellent, Christian. It's going to appear on the income statement. Very good. This is an additional source of revenue to the corporation. Okay, Foster Corporation invested in Coca-Cola. When they sold their shares of Coca-Cola, there was a gain of $500. And that gain is going to appear on the income statement as an additional source of revenue. Excellent. Okay. All right. At this point, we're going to conclude our session for today. Okay. Please run home if you're not there already. Read this particular chapter. It's shorter in length. Okay. Again, it's dealing with the basic principles that you've learned already in accounting. Okay. It just gets a little tricky when it comes to, we're going to see when we continue this chapter, it just gets a little tricky because there has to be an assessment that happens at each year end. Okay, so remember the next session that we have is going to be a taped session. All right, but if you have any questions after, and I would recommend just on Thursday, just sit down and listen to the pre-recorded session. Okay, just so that it's part of your routine. And then if you have any questions, you can email me or text me. And then the following session, which is Tuesday, which is the following session is going to be a holiday or a day off. We're going to meet again on October 1st, and it's going to be live. Okay, but for the first half hour of that session, you're going to have that quiz. There's no recorded session, Jason, for next Tuesday because it's a day off. It's a holiday. You're going to be following Monday's schedule. So, Joshua, you have a question about the quiz. So we're required to have 2 tabs open. No, only McGraw-Hill. That's it. That's all you have to have open. You're welcome, Kareem. Okay, Joshua, does that make sense? So for the quiz, all of you are just going to log onto McGraw-Hill, and the quiz is going to be available there. The recording will be available sometime tomorrow, Lysander. So Monday we're off, but Tuesday, that's exactly right. Yes, so we don't meet next Tuesday. Okay, oh, you're welcome, Denisa. Okay, and again, when I start my session for the recorded session, I'm going to review some of the information we have here. So Joshua, you log on to McGraw-Hill at 10:05. Just 10:05, McGraw-Hill, you have it there for half an hour, and then you're going to come to Blackboard after. Yes, the recorded session will be available, yeah, just as normal. It'll just be here. Okay. You're welcome, Francisco. You're welcome, Joe. Okay, work hard. Read this chapter. You're welcome, Francisco. Keep up the hard work. Okay. Manpreet, you're welcome. Keep up the good work. You too. Thank you. Thank you, Christian. Good work.